Washington, D.C., January 16, 2026. The city wakes up to a chill in the air, but the real storm is brewing inside the halls of power. Today, a bold new policy is about to shake the financial world, and your wallet could be caught in the crossfire. The president steps up to the podium, flanked by advisors, and declares war on high interest rates. In a sweeping announcement, he vows to cap credit card APRs at 10%, promising relief for millions of Americans struggling with debt. The message is clear: the days of double-digit interest are over, and the government is taking a stand. Mortgage lenders are next in line. The administration promises to force them to comply, ensuring that homebuyers and homeowners alike will see lower rates. The handshake between government officials and bank executives is meant to symbolize cooperation, but behind the scenes, tensions are rising. The administration brands this initiative as a new deal for the American wallet, evoking memories of sweeping reforms from the past. Supporters cheer, waving signs and chanting for change, convinced that this is the lifeline families have been waiting for. But not everyone is convinced. Critics on both sides of the aisle warn that this isn't a gift, it's a trap. Opinion columns and heated debates fill the airwaves, with experts questioning whether the government's intervention will really help or just make things worse. Tonight, we break down why this so-called help could backfire spectacularly. Our team of analysts and journalists will dig into the details, separating fact from political spin. On paper, it sounds like a dream come true. Lower interest rates mean lower payments, right? But for families already struggling to make ends meet, the reality could be far more complicated and far more dangerous. Interest rates aren't just random numbers, they're the price of risk. When you borrow money, the rate you pay reflects how likely you are to pay it back. It's a delicate balance that keeps the financial system running. Banks charge more to riskier borrowers, using higher rates to offset the chance of default. It's not personal, it's business. But what happens when the government steps in and says, no more? By capping rates, the government isn't removing risk. It's just telling banks they can't get paid for it. The risk doesn't disappear. It just gets hidden, and someone has to pay the price. So what happens next? Lenders, faced with the prospect of losing money on risky loans, simply stop lending to anyone they see as a potential risk. The doors to credit slam shut for millions, and who gets hurt? Not the wealthy, who have pristine credit and plenty of options. It's the 47 million Americans with subprime credit, people who have made mistakes, faced hardships, or are just starting out. The people who need credit most: the single mom juggling 2 jobs, the recent grad buried in student loans, the gig worker hustling to make rent, find themselves locked out of the system with nowhere to turn. Desperate for cash, they'll be forced to turn to payday lenders and loan sharks who operate outside the law and don't care about rate caps. These lenders charge sky-high fees, trapping borrowers in cycles of debt that are almost impossible to escape. What was meant to be a helping hand could become a financial prison sentence, locking millions into a lifetime of debt. The question remains: is your wallet really safer, or are you just trading one danger for another? Tonight will help you decide. At the heart of this unfolding drama is a very public and unprecedented feud between the president and the Federal Reserve. What was once a behind-the-scenes tension has now erupted into the spotlight, with both sides making their positions clear for the world to see. The Federal Reserve, often called the Fed, is designed to be the impartial referee of the U.S. economy. Its job is to manage the money supply, keep inflation in check, and ensure stable growth, all while staying above the political fray. The Fed's independence is meant to shield it from short-term political pressures, allowing it to make tough decisions that are best for the long-term health of the economy. But the president has a different agenda. With an election looming, he's pushing hard for lower interest rates, hoping that cheaper borrowing will boost the economy and keep voters happy. After all, a strong economy is a powerful campaign tool, and happy voters are more likely to re-elect a sitting president. This isn't just political theater for the cameras. When the world's largest economy shows signs of internal conflict, it sends shockwaves through global markets. Investors and foreign governments start to question the stability and predictability of the U.S. financial system, which has long been a cornerstone of global trust. When the president publicly attacks the Fed, it rattles investors. They worry that economic decisions are being driven by political motives rather than sound data and analysis. This uncertainty makes markets volatile and can lead to sudden sell-offs. Nervous investors become reluctant to buy U.S. government debt, fearing that political interference could lead to poor economic outcomes. Ironically, this can actually push interest rates higher, the exact opposite of what the president wants, making it more expensive for the government to borrow money. The president's strategy is clear: use the bully pulpit to pressure the Fed into cutting rates, regardless of the risks of rising inflation or long-term instability. This approach may score political points, but it undermines the careful balance the Fed tries to maintain. Turning the Fed's job into a political tool is dangerous for everyone. It erodes the credibility of an institution that's supposed to act in the nation's best interest, not in service of any one administration. The world trusts the US dollar because it's governed by rules, not the whims of politicians. This trust is what makes the dollar the world's reserve currency, relied upon by countries and businesses everywhere. Undermining the Fed's independence for short-term political gain gambles with America's credibility. Once that trust is broken, it's incredibly hard to rebuild, and the consequences can last for generations. When trust in the system cracks, it's not the powerful who suffer first. It's ordinary people, families struggling to pay bills, retirees watching their savings shrink, who fall the furthest and feel the pain most acutely. The very foundation of our financial system is at stake. If we allow politics to erode the independence of the Fed, we risk undermining the stability and prosperity that generations have worked to build. Let's break down what a 10% credit card interest cap really means for Americans. On the surface, it sounds like a simple fix. Just limit how much banks can charge, and suddenly, everyone pays less. But the reality is far more complicated, and the consequences could ripple through the entire financial system. It sounds like a dream. Lower rates for everyone. Imagine opening your statement and seeing a single-digit interest rate, no matter your credit score. For millions, that would feel like a financial windfall, a gift from lawmakers determined to help the average person. But this idea ignores the basic mechanics of lending. Banks and credit card companies aren't just picking numbers out of thin air. They set interest rates based on risk, how likely it is that a borrower will pay them back. When you cap rates, you're not just limiting profits, you're also limiting the ability to cover losses from people who can't pay. High APRs aren't just about making money. They're a buffer against the reality that some borrowers will default. Without that buffer, lenders have to make tough choices about who gets credit and who doesn't. Think of it like car insurance. If insurers had to charge everyone the same, regardless of driving history, they'd quickly stop covering anyone with a record of accidents or tickets. The risk would simply be too high. That's exactly what could happen here. Lenders would simply stop offering credit to the 47 million Americans with low credit scores. These are people who already struggle to access affordable loans, and a cap could shut them out entirely. The result? Not better rates, but no credit at all for those who need it most. Instead of helping, the cap could leave millions with no options when emergencies strike or when they need to bridge a gap in their finances. Economists call this a credit crunch, a sudden tightening of lending that hits the most vulnerable the hardest. When banks pull back, it's not the wealthy who suffer, it's the families living paycheck to paycheck, the small business owners, and the young people just starting out. For many, credit cards are a lifeline. They're what keep the car running after a breakdown, pay for a surprise medical bill, or cover rent when a paycheck is late. Take away that safety net, and the consequences can be devastating. When traditional credit dries up, people don't just stop needing money. Instead, they turn to payday loans and pawn shops, where interest rates can soar to 300% or more. These are the real predators, waiting in the shadows for desperate borrowers. The cap isn't a safety net, it's a wall, locking out those who need help the most. It doesn't protect the vulnerable, it isolates them, forcing them to make impossible choices. The policy meant to protect the vulnerable could actually push them into the arms of real predators. Good intentions can sometimes lead to bad results, especially when the math just doesn't add up. In the end, the numbers tell the story. Without a way to balance risk and reward, lenders can't afford to serve everyone. The math just doesn't work, and millions could pay the price. If you have good credit, you might think a rate cap is great news, but there's no free lunch. Credit card profits fund rewards programs, cashback, miles, fraud protection. Cap the rates, and those perks vanish. Say goodbye to sign-up bonuses and travel points. To make up lost revenue, banks will add new fees, annual fees, processing fees, even because we can fees. Merchants will pay higher swipe fees, and they'll pass those costs to you with higher prices. So, your lower interest rate means higher prices everywhere. Community banks and credit unions, already operating on thin margins, could be wiped out. They'll stop offering cards or merge with big banks, reducing competition and choice. The policy doesn't just hurt big banks, it crushes the little ones. Local banking suffers and consumers lose options. The unintended consequences hit everyone. Rate caps come with a hidden price tag. The president's push for lower rates extends to the housing market. The plan used Fannie Mae and Freddie Mac to buy mortgages and force rates down, especially for first-time buyers. The goal is affordable housing, but the risk is a destabilized market. Lower rates mean more buyers, but the number of homes stays the same. More money chasing the same houses drives prices up, not down. The policy could spark bidding wars, soaring prices, and a new housing bubble. Current homeowners win, but first-time buyers get priced out. The real danger. When the bubble bursts, taxpayers are left holding the bag. Fannie and Freddie will be loaded with risky loans at low rates, just like before the 2008 crisis. We're repeating old mistakes, this time by government order. When defaults rise, it's the public who pays for the bailout. It's a house of cards, and the stakes are higher than ever. If this sounds familiar, it's because we've seen it before. In the 1970s, President Nixon tried to fight inflation with a 90-day freeze on wages and prices. It was popular at first, but it only masked the problem. When controls lifted, prices exploded, leading to years of stagflation, high inflation, and stagnant growth. The lesson: you can't legislate away economic reality. Capping interest rates is just another form of price control. The government is setting a price for money below what the market allows. The result? Distortions and shortages, like people unable to get loans or community banks running dry. The 1970s taught us that political fixes for economic problems come with years of pain. Today's leaders seem determined to ignore that lesson. We're watching a rerun of a show with a terrible ending. Economic laws can't be wished away. What's happening now is called financial repression. It's when the government manipulates the financial system to benefit itself, at your expense. By forcing interest rates low, often below inflation, your savings lose value every year. You see a bigger number in your account, but it buys less. The government, the biggest debtor, benefits by paying back debt with cheaper dollars. Savers, especially retirees, get punished as their nest eggs shrink in real terms. Financial repression quietly transfers wealth from you to the government. The president's policies are creating this environment: low rates, high inflation, and eroding savings. It's a hidden tax, never voted on, that hits every dollar you save. Most people don't even see it happening. The illusion of prosperity hides a slow drain on your wealth. Politics is hijacking the value of your money. So, what can you do? You're not powerless. First, understand the new rules. Holding cash is a losing game when inflation outpaces interest. Pay down high-interest variable-rate debt, especially credit cards. If you have a mortgage, lock in a fixed rate. Inflation makes your payments cheaper over time. Think like an investor, not just a saver. Own assets that can't be devalued by printing money. Stocks, especially index funds, tend to keep up with inflation. Real estate, even through REITs, can provide income that adjusts with inflation. Build an emergency fund for liquidity, but don't hoard cash. Be skeptical of political promises about free money. Every intervention has a hidden cost. Protect your purchasing power with minimal debt, real assets, and financial literacy. In this environment, only you can protect your money. We're at a crossroads. The government's moves, pressuring the Fed, capping rates, manipulating mortgages, are more than policy debates. Money is becoming a political weapon, used for short-term gain at the expense of long-term stability. History shows this path leads to ruin, chronic inflation, stagnation, and lost trust. When savers are punished and debtors rewarded, society's fabric unravels. The independence of the central bank and the integrity of the dollar are the bedrock of prosperity. These policies are popular, but popularity doesn't make them wise. Sound money requires discipline, even when it's unpopular. Abandoning that discipline risks more than a recession. It risks the credibility of the US dollar. The fight over interest rates is about your future, your work, your savings, your security. Our institutions are being tested by political ambition. If money's value is set by politicians, we lose control over our economic destiny. That's a price too high to pay.